Welcome back to the channel. I'm John, and today is January 27th, 2026. Before we begin, if you're finding value in this analysis, please comment below and let me know. For those following my real-time market analysis and data updates, you'll find additional resources on X. The link is in the description. What transpired in precious metals markets over the past 48 hours represents a potential inflection point that every serious investor needs to understand. Within hours of each other on January 27th, we received two pivotal developments that demand attention. First, Reuters reported that Citigroup raised their 0 to 3 month silver price forecast to $150 per ounce, up from $100. That represents a 50% upgrade to their near-term target. Second, Bloomberg published an extensive interview with James Emmett, CEO of MKS PAMP SA, one of the world's largest precious metals refiners. His assessment was unequivocal. There's immense silver demand in a way that we've really not seen before. Here's why this convergence matters profoundly. Citigroup operates in the derivatives market. Futures, options, institutional hedging. They analyze COMEX positioning, client flows, and risk management across the financial system. When a major investment bank raises a near-term price target by 50%, they're not speculating, they're managing institutional risk and preparing clients for significant market movement. MKS PAMP operates in the physical market. They refine metal, facilitate delivery between mines, mints, dealers, banks, and industrial buyers. When their CEO characterizes demand as unprecedented, he's observing actual order books and metal flows in real time, not analyzing charts. When a major bank trading paper futures and a major refiner moving physical metal both deliver the same message on the same day, the signal becomes impossible to ignore. This isn't coincidence. It's confirmation from two independent sources operating in completely different market segments, reaching identical conclusions. Let me walk you through the evidence, what it means, and where we're likely headed based on this data. Let's establish the performance context. Silver more than doubled during 2025, posting its best annual performance since 1979, a 46-year record. In 2026 thus far, silver has surged an additional 50% in less than 4 weeks. On Monday, January 26th, silver reached a new all-time high above $117 per ounce, recording the largest single-day intraday jump since the 2008 financial crisis. As of today's session, silver is trading in the $110–$112 range. This isn't a speculative bubble deflating, this is structural repricing, and both Citigroup and MKS PAMP confirm the underlying drivers remain intact. Now here's where it gets critical. James Emmett's Bloomberg interview revealed physical market conditions most investors never see. According to Emmett, retail and wholesale silver orders substantially outstrip available supply. Massive flows to India continue squeezing the global wholesale market. But here's the detail that confirms everything. Silver is now being air freighted instead of ocean shipped. Emmett's exact quote, "Now you simply can't wait for containers to drift across the ocean that long. Consider the implications. Air freight costs 5 to 10 times more than ocean freight for bulk commodities. Market participants only absorb this premium when urgency absolutely trumps cost, when the risk of losing access to physical metal outweighs expedited delivery expense." This isn't retail investors panic buying coins. This is wholesale, industrial, and institutional demand operating in a market where supply chains cannot deliver metal fast enough at current prices. When you're air freighting a bulk commodity like silver, you're admitting two critical facts. First, the supply chain is under severe stress. Second, physical availability has become the primary constraint, not price. This represents fundamental breakdown in normal market function. In efficient commodity markets, price adjusts to balance supply and demand. But when buyers willingly pay massive premiums for immediate delivery regardless of spot price, the paper price has become divorced from physical reality. The air freight phenomenon reveals something even more significant about market psychology. Sophisticated wholesale buyers and industrial users are making decisions based on availability risk rather than price risk. They're effectively saying, we need this metal now, and we'll pay whatever it costs because waiting means potentially losing access entirely. This behavior only emerges when participants believe supply constraints are worsening rather than improving. If buyers expected more supply soon, they'd wait for cheaper ocean freight. The fact they're not waiting tells you everything about their assessment of near-term supply conditions. When Citigroup models a 150 price target over a 0 to 3 month horizon, they're conducting sophisticated risk scenario analysis, incorporating COMEX inventory levels, ETF flows, industrial hedging patterns, speculative positioning, and physical market tightness. Their research note explicitly stated, "We've been bullish on silver both outright and relative to gold for many months, and remain so over the coming weeks." This language is critical. Outright bullish means they expect silver to appreciate in absolute terms. Relative to gold means they expect silver to outperform gold on a percentage basis, a dynamic that historically occurs when industrial demand surges or when catch-up dynamics engage after gold leads higher. Both dynamics appear operating simultaneously. Citigroup is effectively telling institutional clients this market could move violently because the underlying structure has become fundamentally unstable. Position accordingly or risk significant losses. The 50% upgrade also reveals urgency. A 0 to 3 month horizon is extremely short in commodity forecasting. The abbreviated time frame suggests Citigroup expects factors driving silver higher to intensify rapidly rather than gradually. This urgency aligns perfectly with Emmett's observations about air freight and unprecedented demand. James Emmett addressed speculation directly. You are definitely seeing more price action driven by short-term players in the futures market. This is noteworthy because silver traditionally hasn't been heavily speculative compared to gold or equities. But now, speculation is driving significant volatility. Multiple factors explain this. First, fear of missing out. Investors who missed gold's rally are using silver as a high beta alternative. Second, macroeconomic uncertainty. Bloomberg framed this as a major bet on macroeconomic turmoil and geopolitical risks. Third, liquidity dynamics. Gold's daily London turnover is approximately 5 times silver's at current prices. This means substantially less capital can move silver dramatically. When large capital flows enter a thin market, price discovery becomes volatile in both directions. We witnessed this Monday with the largest intraday move since 2008. Emmett characterized this as a devaluation trade, capital flowing from bonds and currencies into hard assets. But silver's moves are faster and more violent than gold's because of the liquidity gap. This creates both opportunity and risk. Silver can deliver outsized returns if the thesis plays out, but leverage and speculation can create violent reversals that shake out participants even when the long-term direction is correct. The technical picture reinforces the fundamental thesis. Silver decisively broke above its 200-day moving average with strong volume confirmation, suggesting institutional accumulation rather than retail speculation. The relative strength index on daily timeframes shows elevated but not extreme levels, indicating strong momentum without exhaustion. Most significantly, the 50-day moving average recently crossed above the 200-day moving average, the golden cross pattern that historically precedes sustained rallies. When fundamental analysis, physical market stress, institutional forecasts, and technical indicators all align simultaneously, it creates confirmation, multiple independent data streams pointing to the same conclusion. Citigroup's $150 target acknowledges that technical momentum and physical market reality are reinforcing each other. However, technical caution signals exist. Bollinger Bands show silver trading near the upper band, often preceding short-term pullbacks. The distance between current prices and the 50-day moving average is larger than historical averages, suggesting prices may need consolidation. Now here's what neither Citigroup nor MKS PAMP will state explicitly, but which evidence strongly suggests the paper market is losing its grip on price discovery. For decades, COMEX futures and LBMA forwards set the global silver price. Physical metal traded at small premiums or discounts to the paper benchmark. This system worked when physical supply could meet demand at futures-determined prices. Arbitrage kept paper and physical prices aligned. But when demand overwhelms supply, when metal must be air freighted, when wholesale buyers cannot wait for standard shipping, the paper price becomes functionally irrelevant. Physical buyers pay whatever is necessary to secure metal immediately. Premiums explode. Arbitrage mechanisms break down because the constraint isn't price, it's availability. Futures markets face choosing between delivering physical metal or entering backwardation, signaling physical shortage. We're not fully in backwardation yet, but structural cracks are clearly visible. Emmett's comments about air freight are symptoms of a market transitioning from paper-dominated to physical-dominated price discovery. Citigroup's 50% upgrade communicates to clients. The old models no longer apply. The market regime has changed. When commodity markets shift from adequate supply to structural deficit, price must rise until demand destruction occurs or new supply comes online. But new mine supply requires 5 to 10 years to develop, and industrial demand driven by solar, electric vehicles, electronics, and defense is policy mandated. It doesn't stop because prices rise 10 to 20%. Industrial users absorb cost increases and continue purchasing because substitutes often don't exist. This creates scenarios where price can move substantially higher before equilibrium is restored. Professional analysis requires examining the bearish case with equal rigor. Risk number 1 is volatility. Silver can spike 20% in a week and retrace 15% in 2 days. Emmett explicitly noted short-term speculative players are driving price action, meaning momentum traders, algorithms, and leverage. When leverage unwinds through margin calls or stop-loss triggers, Corrections are severe and rapid. Traders using tight stops or high leverage can be stopped out on volatility spikes even if the long-term thesis proves correct. If you cannot tolerate seeing positions down 15% for weeks before recovering, silver may not suit your risk tolerance. Risk number 2 is recession. Global economic slowdown could temporarily reduce industrial demand. If solar installations stall, EV sales decline, and electronics demand weakens, silver experiences selling pressure. However, green energy spending is increasingly policy-driven rather than market-driven. Governments subsidize renewable energy as infrastructure policy with political momentum independent of economic cycles, making it more resilient than traditional industrial demand. But policy support could change with fiscal crises or political shifts. Risk number 3 is supply response. Potential supply increases could pressure prices. A major new mine, surging recycling rates, or effective substitutes. Near-term supply response faces significant constraints. Mine development requires 5 to 10 years. Recycling hasn't kept pace with demand growth. Substitutes exist for some applications, but silver's unique properties, particularly electrical conductivity, make it irreplaceable in many high-tech and energy applications. These are long-term buffers, not 90-day solutions. Risk number 4 is Federal Reserve policy. If the Fed pivots toward aggressive rate hikes, real yields could spike, creating selling pressure on non-yielding assets. However, current Fed rhetoric suggests holding or potentially cutting if growth slows. Lower rates reduce the opportunity cost of holding silver. If inflation remains elevated despite rate hikes, keeping real yields negative or minimal, the macro environment continues supporting hard assets. Current policy backdrop appears more favorable than unfavorable for silver, but could change rapidly. These risks are real and material. Citigroup's $150 target is a forecast, not a guarantee. Emmett's observations about unprecedented demand describe current conditions, not permanent states. Markets can reverse rapidly. Anyone dismissing these risks is not conducting professional analysis. Risk management and position sizing are paramount. Let's discuss what this setup means for different market participants. For physical holders who own silver coins, bars, or allocated storage, today's developments provide substantial validation. The supply-demand imbalance is real. Industrial demand is real. A major global bank and major global refiner both confirmed it on the same day. Structural bull markets rarely move in straight lines. They build gradually, consolidate, then advance explosively when pressure overwhelms resistance. We may be entering that explosive phase. If you purchased physical silver at lower prices, you're sitting on substantial gains. Whether to take profits or hold depends on your original thesis. If you bought as portfolio insurance against currency devaluation and systemic risk, reasons to hold have strengthened. If you bought speculatively for quick gains, current levels may represent appropriate exits. For active traders working with futures, options, or leveraged ETFs, Citigroup's $150 target in 0 to 3 months is aggressive and tradable. If we reach $150 with drivers intact, the next leg could go higher. However, momentum can reverse violently. Professional risk management requires defined stop losses, appropriate position sizing, avoiding excessive leverage, and taking partial profits on strength. Consider scaling into positions rather than going all in, using volatility to accumulate at better prices, and setting profit targets at key levels like $125, $140, and $150. For those currently uncommitted, you've received 2 major institutional signals. A global bank raised short-term targets by 50%. The CEO of one of the world's largest refiners characterized demand as unprecedented, with metal being air-freighted due to urgency. You can dismiss this as hype or conduct deeper analysis to determine if evidence supports the thesis. I'm not recommending specific action. I'm recommending critical thinking, independent verification, and informed decision-making based on your situation, risk tolerance, and objectives. Here's a strategic framework for thinking about silver exposure. First, determine your investment objective. Are you seeking portfolio insurance, speculative gains, inflation protection, or systemic risk hedging? Your objective determines appropriate position sizing and time horizon. Second, assess risk tolerance honestly. Can you handle 20% drawdowns without panic selling? If not, size positions smaller or use physical metal rather than leveraged instruments. Third, decide on implementation. Physical metal, mining stocks, ETFs, futures, and options all provide exposure, but with vastly different risk-return profiles. Fourth, establish rules before investing. What price would cause you to add positions? Take profits? What developments would invalidate your thesis? Pre-established rules prevent emotional decision-making during volatility. Fifth, size positions appropriately. No single position should exceed 10-15% of your portfolio unless you have specialized expertise and high risk tolerance. 3 critical takeaways. First, Citigroup and MKS PAMP confirmed on January 27th that silver's market structure has fundamentally changed. Second, underlying drivers are structural, not speculative. Industrial demand, supply constraints, geopolitical fragmentation, and monetary policy all push in the same direction. Third, the paper market's control over price discovery is weakening. When physical buyers pay massive premiums to air freight metal, futures prices no longer represent true market clearing levels. As we conclude, I want to emphasize several critical points. This presentation is educational analysis, not investment advice. I am not a registered financial advisor, and I don't know your personal financial situation, risk tolerance, investment horizon, or objectives. Here's what I recommend every viewer do. First, conduct independent research. Verify every claim. Read the original Citigroup research and full Bloomberg interview with Emmett. Examine COMEX inventory data, ETF flows, and industrial demand statistics yourself. Second, understand your risk tolerance clearly. Silver is volatile. Prices can move 10-20% in either direction within days. If volatility causes emotional distress or financial strain, adjust position sizing or avoid entirely. Third, never invest capital you cannot afford to lose completely. This applies to all investments, but particularly volatile commodities. Capital needed for living expenses, emergency funds, or near-term major purchases should not be invested in speculative assets. Only risk capital that you could lose entirely without impacting financial security should be deployed in volatile markets. Fourth, base decisions on evidence, logic, and clear understanding, not hype, fear of missing out, or someone else's forecast. Your financial decisions should be yours, made with full awareness of risks and opportunities. The convergence we witness today is significant. A major investment bank and major physical market participant, both confirming fundamental market change, provide substantial evidence for structural repricing thesis. But evidence is not certainty. Markets remain unpredictable over short horizons despite strong fundamental trends. Black swan events occur, unexpected developments emerge, nothing is guaranteed. Approach this opportunity. If you determine it is an opportunity for your situation, with appropriate caution, professional risk management, and realistic expectations. Expect volatility, corrections, and moments of doubt. These are normal features of bull markets. If you found today's analysis valuable, please like this video and subscribe to the channel. Your support helps me continue providing institutional-grade analysis accessible to individual investors. Drop a comment sharing your perspective. Are you positioning for continued appreciation? Waiting for better entry points? What aspect of today's analysis do you find most compelling? For real-time market updates and additional charts, follow me on X. The link is in the description. Remember, invest with discipline, manage risk professionally, and base decisions on evidence rather than emotion. The greatest investment mistakes come not from being wrong about direction, but from having correct analysis with poor risk management. You can be right about silver reaching $150 and still lose money with excessive leverage, poor position sizing, or inadequate stops. Process matters as much as analysis. Thank you for watching. I'll see you in the next analysis.